If you haven't already, before you leave, be sure to visit this month's Breakfast Spotlighters, H&R Block, Make Their Day Physical Therapy and Wellness, and Tech Resolve Maine Raffle. And I'd like to take a moment to welcome our new chamber members. They include Assistance Plus, China Four Season Club, Elm City Addiction and Psychiatry, PC, Junior Achievement of Maine, Roof Restore, Sean Packard for State Rep, District number 64, and TBL Aesthetics Day Spa. At this time, I'd like to remind you to turn off your cell phones in consideration of our guests, and please don't forget to complete the evaluation forms that are at your table. Our committee uses this information to shape what we're going to do for programs next year. We also provide the feedback to the speaker so that he or she can hone their presentation skills. Tonight, we have a Meet the Reps, and it's a special one because we're doing an update with the Maine State Chamber of Commerce. They're going to give an overview of what the hot topics are going to be in the second half of the legislative session. It's from 5:30 to 7 at Bricks Co-working in the Hathaway Creative Center. Beverages and light refreshments will be served. It's free. And we have our first business after hours a week from Wednesday, January 21st, with Maine General Medical Center at the Thayer Center for Health at 149 North Street in Waterville. Again, that's from 5:30 to 7. Join us for good food, good drinks, networking, 50/50, and door prizes. And our next business breakfast, of course, will be held here a month from today, February 12th, from 7:15 to 9. And the topic is creating accessible digital content. And it's being presented by Maine Site. Its director, Liglani, will share how to create accessible social media content, including posts, images, and videos that can be used by everyone regardless of learning, physical, or vision limitations. Includes the new web content accessibility guidelines, which make digital content accessible to all users, especially those with disabilities. So you can register today at midmainechamber.com. We also have openings for business spotlighters at this event, which again is free. You just have to provide a door prize. If you're interested in being a spotlighter, you can reach out to Cindy at Mid-Maine Chamber. Today's presentation with Andrew Wells will offer insight into the Affordable Care Act and OBBA, is that too many B's, Act and resulting implications for your organization. There's going to be time provided at the end for Q&A. This is live streamed, so people are listening right now, and it's also taped, and we can provide you with a link if you want to see it afterward. This morning, because she's not done yet, even though she's off the board, VP of Human Resources at Thomas College, Michelle Jolalabi, is going to introduce Andrew for us. Michelle?
Good morning, everybody. It is my pleasure to introduce Andrew Wells from PretiFlaherty. Andrew is a trusted advisor to businesses of all sizes, offering tailored tax solutions with a strong foundation in the law and a focus on long-term success. Based in PretiFlaherty's Portland office, he focuses his practice on tax research, planning, and guidance across a wide spectrum of business matters, including corporate reorganizations, equity investments, mergers and acquisitions, tax-exempt organizations, and federal and state tax issues related to corporations, limited liability companies, partnerships, cooperatives, tax-exempt organizations, tax credits, and sales and use tax. Whether working with a small locally owned business or a large corporation, Andrew is known for his ability to translate complex tax concepts into clear, actionable advice. He works closely with corporate clients to provide support on contract negotiations, tax considerations, service agreements, and governance matters, also advising on internal revenue code compliance, conflict of interest, and other governance policies for tax-exempt organizations, grant-making rules for public charities and private foundations, and the unique challenges facing affiliate advocacy organizations. Outside of the office, Andrew enjoys spending time with his wife and children, Brazilian Jiu-Jitsu, running, surfing, snowboarding, and skiing. Please join me in welcoming Andrew.
Thank you very much. So am I speaking into this one or this one? No, the one I have here? Fuzzy one. Okay, sorry. Thank you. We're talking to the fuzzy one.
You don't have to get close to it.
That's all right. Everybody hears me all right?
Yeah.
All right, great. Thank you so much. I'm going to I should have done this before I came on, but, you know, it was a little bit of excitement. We'll see if we get this to work.
Did you turn it on the back?
Of course not.
On the side, I guess.
Here we go. Off, on. That might help. It's green. We're great. Okay, outstanding. Thank you so much for having me this morning, and thank you so much for, walking through with me while I figure out how all this works technically. Thank you. That was a great introduction. It's great to be with everybody this morning. I said my name is Andrew Wells. I'm a tax attorney and corporate attorney at PretiFlaherty in Portland. My former life, I was also an accountant. One thing you didn't mention, I'm also a dog father. I have 2 young pups at home as well. And 3, she did mention I have 3 lovely little girls, 3, 5, and 7, which one thing you got me out of this morning was getting everybody to school. So thank you to my wife who can't be here. I don't think she's watching on live stream, but thank you for dealing with that this morning as well. So I'm going to talk a little bit about, we call it OBBA, is what the lawyers are calling it, because we like to abbreviate everything, and this has a very, very long name. So the OBBA, which was passed, I'll talk a little bit about the impacts on the ACA. Just so everybody knows, I'm not an ACA expert. I'm a tax expert. So it did have some impacts in the ACA. I'll talk a little bit about that. I'll talk a bit about the tax impacts that it has as well. A lot of it is still we don't know exactly. If you guys listen to the news, there's been a lot of talk about how this is going to impact the marketplace, how this is going to impact people's premiums, are there going to be changes. There's a lot of speculation there may be more changes coming, but with the way things are going in Washington, who knows, right? It's probably nothing going to happen too fast if I had to guess, but it's a lot of speculation at this point. So on July 4th, OBBA was passed. As I said, made changes to the ACA marketplace. The made changes and shift employees' employer plans. A lot of the tax changes are going to be basically giving benefits to kind of capital-intensive businesses, which may benefit from the bonus depreciation. That was kind of a big, one of the big benefits potentially. Not new concepts, but expanded and further benefits there. And a big piece, as I was talking earlier, was a big piece of this bill is expanding on the TCJA changes that were made back in 2017 with President Trump's first administration. Back then, when that bill was passed, there were a lot of big, kind of interesting, novel changes to the tax code that we all had to wrap our arms around, get an understanding. Some of those were pretty big benefits to small businesses and large businesses alike. We don't have as much of that here. So there's not a lot of new concepts that we're now trying to learn. But a lot of those were supposed to sunset in 2026. So those have been made permanent, many of them. And there have been kind of changes around the edges to those. So when we hear that there was this big tax cut, in many ways the tax cut happened, back in 2017. And now we're just extending those tax cuts. And there are some improvements, some increases and tweaks to that bill. It's not all, some things that bill also took away because, they got to figure out a way to somehow make the numbers work, theoretically, I guess. So some deductions have been taken away as well, and some of those have been made permanent. But again, A lot of it is more or less extending those. Oh, a quick note on with the ACA, as far as a lot of the rules that were changed in there, when you have these requirements for the employers of the 50 and under, not being required to provide health insurance to the employees, and the 50 and over being required to provide health insurance. Those rules haven't changed. The individual mandate that was done away with years ago in the ACA, that hasn't changed. A lot of the changes here, and that if you've been listening a little bit to the talk around this, have been to what is going to be accessible to the marketplace, which, in my experience, impacts a lot of small businesses' employees, which I'll talk about a little bit, because there've been times with I think many small businesses, maybe 10 employees, 15 employees, where you may not be required to offer life insurance, but you may want to for one reason, not life insurance, health insurance. You may want to provide that benefit to your employees. It has been very difficult because, I say difficult to get a plan because a lot of times it's been difficult to get buy-in because your employees may have been getting, basically more competitive rates on the marketplace. So that's going to very possibly change. So anyway, we'll get into it a little bit here. All right, so the ACA impact. So what do we have in OBBA here? So the big news that many of us have heard about, the not extending the enhanced premium tax credit, eliminating automatic enrollment for those receiving the premium tax credits, the removal on the cap, the amount the credit enrollees must repay if their income changes. So a little bit, basically more of a risk to employees when you have a change in your income. If you may be qualified for a credit and mid-year you don't, more people will have to basically pay that back at this point. Shorter enrollment periods, fewer special enrollment opportunities, eliminates the continuous special enrollment period for low-income individuals, ends the monthly low-income special enrollment period and state-based marketplace special enrollment periods, stricter income verifications, expected new rule changes to the CMS rules coming in 2026, which is expected to increase the out-of-pocket costs. It's going to adjust the applicable percentages for the premium share of income. And there were initially, the ACA had, I believe in the budget that was in the bill that was kind of got stripped out, there was going to be potentially some changes to the individual coverage health reimbursement arrangement, and they had actually put in some credits for small businesses that were providing health care to their employees. Those were actually taken out, so there are no changes there. So what are all of these have in common? It's been potentially, depending on who you ask, but it looks like it's going to be more difficult, or more, I shouldn't say more difficult, but it'll be more of a process for those to get on the marketplace and to get their insurance. The periods have been cut, and without some of these the tax credits, the premiums are. I think it's pretty common. They agreed that the premiums are going to go up for those using the marketplace. So it's going to be for those that have employees that maybe have had access to marketplace insurance and have maybe been getting very affordable or more affordable deals through the marketplace. It's going to likely become more expensive, and it's going to become a little bit more challenging to actually get your insurance on there. So as I said in the opening, so what do we expect here? It's going to be less attractive, likely, for many employees to go onto the marketplace. So for many, small businesses, for example, my wife and her family own a business. They have about 10 to 15 employees usually throughout the year. In the past, they have offered health insurance. It's gone back and forth throughout the years of whether or not they've done it. Most recently, before this happened, they wanted to offer insurance as a benefit to their employees. Some employees asked for it, and they went and looked into it. And what they were told was basically, it's not going to make any sense. Your employees are going to get better insurance on the marketplace because they had such a small pool of employees, and they couldn't get enough buy-in from the employees to join the program. That may shift. You may see some shifting there. We can't predict the future as to what is actually going to happen. It's going to be kind of case-by-case basis for a lot of businesses, but I would imagine that you will see you'll see more buy-in for those. It'll be more attractive for a lot of employees if you are offering those benefits. And I did notice I was going through these. I have a typo. I don't need to, I will point it out because I can't help myself. But it's just supposed to say will there be more affordable? I mean, will plans become more affordable for small businesses or some very small businesses? Can't speculate. I can't speculate, but maybe in certain cases it could be. There's also, talk of, maybe extending some additional credits in the future to small businesses that are offering care. One would hope that there's going to be some changes made and some further tweaks down the road. We can't predict. Who knows what's going to happen with politicians? If I could, I would be a much wealthier man if I could predict what's going to happen in the future. But we'll hope because things are becoming quite unaffordable. It's already challenging for a lot of people to get good health insurance. And honestly, another piece of these changes, some of the expected rules, is that honestly care premiums might go up and the coverage might go down a bit because some of those rules have been loosened a little bit. So, but these things could change. It is a fluid situation. So some kind of related benefits that were included in here are some other health-related savings and options. I think there is some move towards. So there's a telehealth safe harbor was permanently allows high deductible health plans to remain HSA eligible. Basically, I think there's a little bit. I think this administration maybe likes the idea of HSAs and are making them a little bit more accessible, attractive. For those of you that I'm sure many of you know. HSA is a concept that's been around for a while now. It's a great, both a savings plan and you can only get them with the high deductible plans, but it is a way to basically save a certain amount of money that's tax deductible to you. You can put money in an account and you can actually invest those funds and have those funds grow for years and years and years, and you don't need to kind of take the money out to get the benefit, and you can let that grow, and then in future years, once that money's grown, you can use them for health costs in the future. I think the original idea was for you to put money away and use it as things maybe medical issues came up, which you can certainly still use those for. But I know a lot of wealth advisors are recommending people like, hey, put money in those, let that HSA grow, have it invested, have that money grow over time, and you can use those, much later in life, and it can be a big benefit as based when you retire, things like that. So anyway, my wife has been really on me about these HSAs and putting money away, and the more I look into them, they are great plans and great ways to to build well. People almost use them as IRAs in a sense. That's not exactly what they're designed for, but it's a good way, another good way to put money away, because as we get older, things can happen, and our health insurance, our health costs can rise. So we seem to be putting out more incentives, is the word I was looking for, to kind of invest in the HSAs. The higher dependent care assistance exclusion increased from $5,000 to $7,500, and dependent care tax percentage rate increase. So those are some little benefits on people's personal income taxes as well. So some additional health-related options and employee benefits. So some of these, and I say benefits, some of them are actually not benefits. They're actually things that the TCJA removed that have been made permanent, which is a theme throughout the OBBA bill, is that many things that were set up to be temporary in TCJA are now made permanent. The employer payment for student loan exclusion, that's permanent. There was a qualified bicycle reimbursement that was removed in TCJA. That was set to be temporary. That's been made permanent, so that's a benefit that if anybody was using years ago, that's still no longer available. The moving expense deduction, which was removed by TCJA, which I do see come up a lot, that was made permanent, so that's not tax deductible. There was a adoption credit enhancement. The employer credit and paid leave and medical leave was made permanent, so that's it's a helpful credit and benefit to offer. There was changes so back with TCJA, the employer provided meals deduction was removed. That is made permanent, but there was some tweaks to that, small tweaks around from exceptions that were added, and one that I found interesting being in Maine is fishing boats are exempt from that rule. So if you're providing meals on fishing boats, if you're a commercial fisherman, that is allowed now as a deduction, which was not prior. Permanent $5,000 to $250 exclusion for employer-provided student loan programs. And then I have a note, so they extended the statute of limitations on the employee retention tax credit enforcement. And the reason I have this doesn't necessarily impact people's taxes, but the reason this was interesting to me was, we might remember this was a program from COVID where there were some pretty good, pretty substantial potential credits and payroll credits you're getting back as employers. This was kind of a big credit at the time. A lot of people were trying to get this benefit. A lot of people did get this benefit. And like many things with COVID, they didn't, when they put this out, I don't think that they knew how they're going to enforce it. And there wasn't a lot of people looking at it at the time. So what they're doing is giving themselves more time to go back and audit these things. So if your business received these credits, they've extended the amount of time. They may choose to look at whether or not you actually were eligible for those. Hopefully nobody in this room has to deal with it. Those are never fun, but just kind of a warning. Hey, this could still come back. It's still out there. Kind of blow through this one just real quick. I don't know if a lot of people in this room are in the energy credit business, but they eliminate that. This bill is phasing out a lot of the clean energy production, the clean energy credits for building solar farms and wind farms, that type of thing. A lot of that business heavily runs on investors relying on these tax credits, and those have been phased out in this bill. So basically, I think I don't have the specific numbers in front of me, but largely, if you are not, basically, you don't already have these credits, if you're not already putting these projects together, they're not going to be available. This bill also gets rid of some, the alternative fuel, vehicle and refueling property credits. The clean vehicle credits were eliminated. So there are a lot of the basic, like a lot of the clean energy credits from past administrations have been eliminated and phased out. I didn't put it in here, because I don't know how prevalent it would be or how relevant it would be for a lot of people in this room. But there were credits added and boosted for some other types of energy, mostly like oil and gas. So I don't think that necessarily is relevant to a lot of us, but take away one thing because they're given another, basically. I don't have it up here, but the new market credit was made permanent. So it's a kind of an interesting credit out there, which is, I know on a lot of, those are interesting structures, but those have been made permanent. So those are still around, and there's the advanced manufacturing investment credit was increased. So there have been some credits that have been expanded, but a lot of the clean energy credits have been removed. All right, so now the stuff that I'm interested in, that excites me a little bit, and I'll try not to bore anybody too much, because certain people I know used to get into taxes. It's not everybody's favorite topic, but there are some tax benefits here, and there are some good big tax incentives as well. And as I said, a lot of these concepts aren't new. They're either bringing back former concepts, or they're making the TCJA changes permanent. The big one, which is going to be relevant for particularly capital-heavy businesses, is they're boosting the bonus depreciation availability for capital-intensive businesses. So the 100% bonus depreciation for qualified property, so properties with 20 or less tax life, that the 100% depreciation is going to be available. They're increasing the Section 179 amount, which is 179 is basically it's not technically bonus depreciation, but it's the same effect where you can expense capital investments. So there's a limit to that, which has been boosted up to $2.5 million a year. So expanding that as well. There are some changes around the edges to 163J. 163J was the limit on business interest that you could take. They made some changes to that. This was another TCJA statute. Opportunity zones, which was another TCJA change. These are interesting. These were set, and I'll get into them a little bit further down the road, but these were set to sunset next year. So a lot of investors that may not have been so sure if they wanted to jump in and kind of access these benefits, it's not been made permanent, but it's kind of an interesting outcome with how they did it. The Section 199A change has been made permanent. So this, I'll get into this a little bit more, but if you own a business and that business is taxed on as a pass-through, so partnership tax, S corporation tax, you're paying or disregarded. So if you're paying on your personal income tax return the taxes of your business, there's a 20% deduction, which you may have been enjoying since TCJA. That was also set to expire. We've made that permanent. They've made some changes to it, but nothing too major there. The expanded qualified small business stock rules, there are some changes. Yes, sir.
On the 199A pass-through, could you please clarify that deduction? Is that a 20% deduction above and beyond all of your other deductions
Yes.
for your business?
Yes. Yeah. So it's and I won't get into all the little nuances, but yeah, it's it's around gross, right? So it's on your net income, your taxable income, we'll say, that's passing through. There's a 20%. It's not straight. There are phase-ins, phase-outs, some limitations and things like that. But yeah, it's a 20% deduction on that income. Exactly. The R&D, so R&D deductions have been added, so allowing you to basically take instead of having to take that deduction over time, you can expense R&D deductions. And here the last two are the kind of two that are different concepts that were very popular politically, was the no tax on tips and the no tax on overtime. And I'll get into those a little bit because those are the new ones, and those are pretty interesting as well. So as we were saying, that's that 199A, it's the qualified business income deduction. That's permanent now. The changes, actually we'll skip on, as I already addressed that, but the changes made here were one, so there's a phase in, phase out amount. Those amounts were increased. So that is going to potentially provide, it's a bigger benefit to people who are maybe already in the phase out of that with those. You get a little bit more, the phase out is bigger, or starts at a later, amount. So that's a positive for a lot of business owners. There's also a minimum deduction that was added, which is pretty interesting for those with 1,000 of qualified business income. It's a limit of 400. And there was also inflation adjustments and thresholds and minimums that were added there as well. I said bonus depreciation is the big one. So the 100% bonus depreciation for qualified property. There's also a new temporary full expensing provision for qualified production property. So and this would allow full expensing of certain 39-year property. And as I said in the opening previously, the 179 deduction limit was increased. So I'll talk a little bit. What's qualified production property? This is certain business real estate, which is prior wasn't available to be to be expensed quicker, and you had to take it over a longer period of time. This is actually this is going to be a limited deduction. It's set to basically expire in 2028. But there are going to be some specific rules around this. So requirement to qualify here is to be used by the taxpayer as an integral part of qualified production activity, which means manufacturing, production, or refining of qualified products. A qualified product is generally tangible property with some limited exceptions. The construction has to begin either between Jan 19th, 2025 and before 2029. You have to collect this expense on your tax return, and it has to be placed in service before Jan 1, 2031. So it's limited. This is a limited benefit, but it's available out there if you qualify, and it's going to be an incentive to build some manufacturing, factories, et cetera, et cetera. Oh, and the property has to be used by the lessee of a taxpayer. Property used by the lessee of a taxpayer does not qualify, so it can't be property that you own and then are leasing out. So the excess business interest, there have been some tweaks to this to the extent this impacts anybody. In one hand, the changes are going to allow you to take some more business interest deduction. On the other hand, there was a handy tax loophole that a lot of business owners were taking advantage of, where you could basically decide to depreciate or amortize this interest over time and then take bonus depreciation on that. So it's kind of a workaround to get a bigger deduction. That loophole's been closed. So on one hand, you're going to potentially increase the amount of interest that you can take deduction, but that tax loophole is being closed by this statute. And this is just an excuse for me to talk about qualified small business stock benefits. Talk real briefly, but this is kind of this can be a big tax benefit for those that are forming a company or forming a corporation rather, and then selling it later. So if you're building to sell, I mean, it doesn't need to be, it can be relatively, actually even a shorter period of time now, but it can be in the future as well. Essentially, and it's only for C corporations, meaning corporations that pay corporate income tax, so not S corporations. And it has to be, there are rules around this, has to be your original issue, so for founders and investors that get originally issued stock, not buying your stock from somebody else. But this is a benefit where if you form your corporation, you build your corporation, and then you sell that corporation after holding it for a period of time, you get, now it's going to be up to $15 million that you don't actually pay tax on. So it can be a big benefit if you're building a company to sell it. What has changed in these rules, basically, it made it more attractive. Prior, you needed to hold that stock for 5 years. Now it's a 3-year period, and that the amount of the tax that you could not pay, basically, the income exclusion has gone from 10 million to 15. And also there are requirements. This is small business stock, which is always interesting when we're talking like what a small business is to the federal government and what I think of a small business is and what many of us think of a small business in Maine. There was the limitation of 50 million in assets. That's been expanded to 75 million in assets. So it's going to be more available to more businesses and business owners. It's increased the benefit and it's shortened the amount of time that you have to hold that stock. So this could be a good perk for those who are forming businesses and then selling them. And I will say, to anybody starting a new business, it's a consideration when you're choosing how you want to be taxed. A lot of times, your lawyer or your accountant may recommend, S corporation or partnership, because when you run the numbers, a lot of times the net tax amount you're going to be paying on your individual, out of your own pocket on your income tax, may be more beneficial to go with a pass-through tax. But if you're eyeing this kind of benefit, if you're eyeing maybe selling that down the road, the C corporation actually may be more attractive in that way. It's just something to consider. The R&D benefit now, so we can deduct R&D expenditures instead of having to amortize or basically take deductions over time. We'll get to the no tax on tips. So this was a new one. And that was talked about a lot in the news. At least I heard it talked about a lot in the news. So generally, the concept was, if you were in a lot more employees now are getting tipped out, right? It's not just bartenders and waiters at this point. I mean, it's across many different businesses and industries. So they've added a benefit for those tips as far as not having to pay tax. And it's not actually a no tax on tip. It's not excluding that income. It's a deduction on your income tax. So there are some rules here. The tips must be paid in cash or equivalent. They must be mandatory. Now, what I thought was interesting when I was looking at this was you see certain, you see this in like restaurants, right, where you might have a mandatory, you have party of six and more, we're going to charge you mandatory 18% service fee. Under this rule, that's not considered a tip anymore. That's not voluntary. So technically that wouldn't qualify as the deduction here. Now, you think about when your employee is maybe reporting this, how are they going to differentiate? Are they going to differentiate? It's a big, I don't know, who knows how we're going to kind of parse this out. But might make it a little bit less attractive to have kind of those requirements in the service charge. It's limited to 25,000 unqualified tips. There's a phase out at 150,000 adjusted gross income and 300,000 for joint filers. Extends the FICA tax tip credit credit to tips received in connection with food service. And this is a limited time period. It's only available right now until 2028. And so the Treasury has come out with some guidance. So the question is, who actually qualifies here? And these are the categories they've given. I would have put up a list of who actually, like what actually is a qualified, service here. And the Treasury has provided some guidance on this. I have it here as about 70 they've listed. I was happy. I mean, it made me. I'm weird. I get happy when people get tax benefits. Say ways for people to save money. I didn't expect them to be thinking this so broadly, and it appears that they are. There's a lot of businesses, a lot of different types of businesses that are included in this list that would qualify. So, for example, my wife is in the dog care business. They get tipped. I thought there's no way that they would include like a dog care business specifically in here, thinking that you're traditionally tipped out. Surprise, surprise, it is. It is. The dog care businesses are included here. If you are providing plumbing services in somebody's home and you get tipped out for your service, that's included here. So they did, it was a bit more expansive than I thought it might be, which is great news for a lot of people. Sorry, go ahead.
So that's federal tax?
Yes,
Maine has said that they are still going to tax those trips.
yes,
So that's going to be pretty convoluted.
yes.
Looking at tax ones and doing,
Yes. So, as I often recommend, push that to your accountant if you have it, if you're not doing your own. But yeah, I mean, it's there. So for this year at least, Maine has said they're going to decouple from these changes. So it's similar to. There's also just as a to draw an analysis. I mean, we have this also with depreciation, bonus depreciation rules in years past. It's gone up and down as to whether Maine is going to follow federal. So you're exactly right. It makes for a complicated, convoluted tax return. Maybe this could change in years to come, but for now, for this year, it's going to make it complicated for your main income tax return. And similar, the no tax on overtime, same thing. Maine's decoupling from that as well right now. So the no tax on overtime, similar. We have a 3-year window, so 2025 to 2028. It's limited to $12,500 for single filers and $25,000 for joint filers. Also a phase out for $150,000 AGI for single filers and $300,000 for joint filers. So for employers, in 2025, the W-2, I don't believe they've made changes to the W-2 for this year. So what I've read is the guidance is the employers are required or obligated, to give the employees basically reasonable information as to how they're going to report this. Because again, this is a deduction on the individual's income tax return. So what's the best way to do it? Find a reasonable way to kind of break this out for your employees. In 2026, at least from what I've read, is the W-2 will change. So there'll be a place on the W-2 to put this in. And I would say, I don't know, maybe work with, I don't know what the payroll companies are doing to kind of help with this. But I could probably do, I think they have an idea of what they want to do for 2026, probably do something similar as like an other miscellaneous note on the W-2, I guess, to let the employer know. But it wouldn't be a bad thing to bring up with payroll companies as they're doing the W-2s, just to let the employees know basically how much overtime they made, so they can kind of take a benefit here. As with every changes in year one, it always gets a little messy. So hopefully we'll kind of figure this out going forward in the next year. So, yes, absolutely, good.
No tax on overtime, it's only the piece that is the overtime.
Yes.
It isn't that full pay. A lot
Yeah.
of people out there think that it's the full over 40 hours piece.
Yeah.
Which isn't the case. It's only that half time.
Yes. Yeah.
That is deductible.
Yeah.
In a business owner, if you're a business owner, you think you pay yourself overtime, typically you can't do that.
Thank you very much. All right, so I'm going to close a little. So opportunity zones, I threw this in because it's actually something, interestingly enough, this was when opportunity zones first came out with TCJA, I didn't see a ton of people asking about these. Over the last year, I've had probably 4 or 5 questions in the last 6 months, I think, about opportunity zones, which is really interesting because opportunity zones are set to sunset in 2026. So opportunity zones are a potential tax benefit really for people starting businesses, investing in businesses that are in these designated opportunity zones. I'm not going to, go through there's a lot of nitty gritty as to basically how this benefit works, which I'll leave for another day for everybody. But generally speaking, what it does is if you have capital gains in a year, so if you sell stock, if you sell a business where there's capital gains, the opportunity zones allow you to invest those through essentially like an opportunity zone fund, which then invests into a business entity that is operating in these designated opportunity zones, and let's say they fit all the specific requirements here, and you defer that income. So you don't pay tax. Initially, it was set up, you don't pay tax on your capital gains until 2026, till the end of 2026, which is where we are now. So, but on top of that, if you hold it for 5 years before selling that investment, you get an additional basis step up in your after you've recognized already. So you get an additional tax benefit if you sell it after 5 years, and then if you sell it after 10 years, you get a full basis step up. So you do pay tax. You do pay tax on the deferred income, but then if you sell it after 10 years, you basically don't pay any additional tax on that investment. So this was all set to go away 2026. Everybody pays their tax, and who knows what would happen with the additional benefits. This was we made this permanent. So this was made permanent. So the additional benefits have not gone away. However, if you've already invested in one of these, you would still pay the tax on the deferred capital gains in this year. That hasn't changed. However, all the other benefits with kind of continuing to hold the investment are still there. Now we're going to restart this opportunity zone benefit. So if you invest in 2027, you now have a 5-year period to defer your capital gains. And then you also have these other benefits, the other benefits where you hold it for that 5 years, you get that additional basis step up. And you hold it for 10 years, you get the 100% step up. They've also added rural opportunity funds, which are, I would imagine we're going to have some here in Maine. And so rural opportunity funds, similar rules, except that 10% basis step up that you get after 5 years is 30%. So it's a bigger benefit there. So trying to encourage investment into rural areas. So This is a little convoluted, right? Sorry.
Waterville has an opportunity.
Yeah, we have many. And so another thing is, these are all going to be redesignated too. So going forward in 2027, there's going to be a new map drawn of what the opportunity zones in Maine are and what rural opportunity zones will be. So that should be, we may be seeing some of that information come out mid-year. So what I'm telling, what I tell people when they're asking about these, the deferred benefit, if you do it this year, there's no deferral of your capital gains. You're going to pay capital gains at the end of 2026 because the old rule still applies. There are other benefits, the other step-up benefits that still apply. So if it's the kind of situation where an investor, you don't want the tax tail to wag the business dog or something like that. You don't need to have it. Okay, if it's a good business deal and it needs to happen this year, by all means. But if it's the type of thing where you can wait till 2027, there's going to be more benefit starting in 2027 because you can now take that 5-year deferral and get all the other benefits. So this is kind of an interesting situation where I'd say the opportunity zone world, maybe wait a year, but what I have seen is I've at least one client where they're getting into basically it was a deal they were going to do anyway. Deal was happening, and they found out, oh wait, this could be, opportunity zone. This could fit as an opportunity zone. They're not going to get the deferred benefit, but there are some other like long-term benefits as well. So they're going to, go forward and do it anyway. But in this situation, they couldn't wait. They couldn't wait until 2027. So anyway. What now is the question? Who knows what now, right? I wish I could predict, but with the health coverage, review health coverage options, and employee demand very well might increase, which I would expect potentially. If you plan for capital and if you are a capital heavy business, you're going to get potentially bigger benefits, and some of those, if you're building a factory, things like that, there's going to be more incentives to do those in a short time window coming up here to get some bigger tax benefits. As I just said about the opportunity zones, if you have people that you're talking to about potentially investing in opportunity zones, you're interested in investing in opportunity zones, you're interested in starting a business in opportunity zones, if you can wait till 2027, there's going to be bigger benefits. So it's that's an interesting one, but it's good to know that there are other benefits out there if it's got to happen this year. They're just a little bit further down the road and they haven't gone away. So that's a plus. The last note is coordinate with tax and benefits advisors like myself. To just, decisions will be personalized. So as everything, right? It's gonna depend on your specific situation. All businesses are different. All of them have different needs. So, come talk to me if you have specific questions about your business. I'm happy to take any other questions right now. I think that's the end of my slides. So, go ahead, sir.
There was some discussion about doing away with the 1031 exchange.
Mm-hmm. That wasn't here. No, it's still the same. I mean, 1031s were limited with TCJA, right? It's just real estate, but that still exists. Yes, sir.
Who's drawing the opportunity zone?
I believe the timing it will be, so the current administration in Maine will be the ones kind of putting that out there. I think they need federal approval, I believe, but I think it'll be the Mills administration doing it this year.
Any other questions?
Right.
Thank you.
Thank you guys so much. I really appreciate it.
On behalf of the Mid-Maine Chamber, we want to thank you, Andrew. And we got a little gift for you.
Thank you very much. I appreciate it.
Okay. Reminder to fill out the forms on your tables. And again, if you want to be a spotlighter, grab Cindy or Sabrina at the end of this. We also have some openings for our chamber chatter videos. So if anybody's interested in those, talk to Sabrina as well. We have some wonderful door prizes today. The first is a $10 Sala Tea Cafe gift card that Sala Tea Cafe donated, and that is going to Lisa Boucher from CGI. Sappy has donated a multi-month calendar. I love these things. And that is going to Ryan Poulin from New Dimensions Federal Credit Union. A $10 gift card donated by Roma Droz. Is this the one? Who's going to win this one? Don Fleur? Okay. Let's see. You guys see I'm not looking, right? I'm not looking. Jamie Ford. Yep. For the Love of Coffee swag donated by Crossroads TV, going to Brian Bowman from Bowman Constructors. Let's see, a $25 chamber gift certificate donated by Tech Resolve Maine Raffle is going to Nicole McSweeney from Maine General Health. That's a lucky table. Just got 2 of you left. Let's see, multi-month calendar donated by Sappy is going to Samantha Wood from O'Donnell Lee Martin Dubord. A Club Cadet garden trawl seeds and gloves donated by Central Maine Equipment. Going to Dylan Copeland. Dylan is Sheridan Corp, right? Allen Insurance and Financial is giving away coffee mugs and swag, and that's going to Karen Warren from DECD. Another $25 chamber gift certificate donated by Tech Resolve Maine Raffle is going to Christine Avery from Kennebec Savings Bank. I'm going too fast, sorry. Okay, $150 value certificate for a new patient appointment donated by Make Their Day Physical Therapy and Wellness. And that's going to Joe Jean Dumont from H&R Block. All right, I'm mixing them up good here because this is the $400 valued iPad mini donated by H&R Block. And that is going to Catherine Harvey from AYCC. So that's it. That concludes this month's forum. Thank you for coming. We hope to see you at the February Business Breakfast. Schedules for the whole year for our Business Breakfast series are on the table as you exit. Don't forget to do your evaluation forms. You can just leave them at your table or drop them in the front. Have a great day.
Do you want to get your business seen on the big screen? Have more eyes see who you are? Is your budget holding you back, keeping you from advertising your business? Maybe it's time you contacted Crossroads TV. Inexpensive 10-day campaign, pinpoint accuracy for demographics and geography, and the ability to select some or all of their partnered streaming services. Call us, 207-453-9895.